In the shadow of humanity's greatest technological revolution, a warning has emerged from one of Silicon Valley's most controversial voices. Elon Musk, the man who predicted the AI explosion before most understood what was coming, has issued a stark declaration that's sending shockwaves through the trillion-dollar semiconductor industry. We're moving from GPU shortage to GPU abundance. For 2 years, artificial intelligence companies have waged war over chips. NVIDIA's data center GPUs became more valuable than gold, traded on gray markets, hoarded by tech giants, and fought over in boardrooms from San Francisco to Shenzhen. Entire business strategies were built on a single assumption: that demand for AI processors would continue accelerating forever, that the appetite for computational power was infinite, that whoever controlled the chips would control the future. But what if that assumption was wrong? What if the frenzy we've witnessed wasn't the beginning of an endless boom, but the final stage of a purchasing cycle that's already reaching its natural ceiling? What if companies didn't just buy enough chips to train their models? They bought too many? The numbers tell a remarkable story. NVIDIA's market capitalization exploded past $3 trillion. Taiwan Semiconductor Manufacturing Company became the 10th most valuable company on Earth. AMD's data center revenue grew by triple digits year over year. Billions of dollars flowed into GPU purchases with an urgency that bordered on panic. Hyperscalers built data centers at a pace unprecedented in computing history. The message was clear: buy now, or be left behind in the AI revolution. But Musk sees something different. He sees data centers hitting power limits. He sees training runs reaching points of diminishing returns. He sees efficiency gains that reduce the need for raw hardware. And most critically, he sees companies that have already placed their maximum orders, their infrastructure built, their capacity purchased. The great AI chip land grab, he suggests, may already be over. And if he's right, the implications stretch far beyond Silicon Valley. They could reshape the entire global technology economy. To understand why Musk's warning matters, we need to understand how we got here. The AI chip boom didn't happen gradually, it detonated. When OpenAI released ChatGPT in November 2022, it didn't just capture public imagination, it triggered an arms race. Within months, every major technology company was scrambling to deploy competing large language models. Google rushed out Bard. Microsoft integrated GPT-4 into everything. Meta open-sourced Llama. Amazon, Apple, and dozens of well-funded startups joined the fray. Each knew one fundamental truth: you cannot train frontier AI models without massive computational infrastructure. NVIDIA became the central player in this drama almost by accident of engineering excellence. Their H100 GPUs, designed specifically for AI training workloads, became the industry standard. A single H100 could cost between $25,000 and $40,000, depending on supply constraints. Companies weren't buying dozens, they were buying tens of thousands. Meta alone announced plans for infrastructure containing 350,000 H100 GPUs by the end of 2024. Microsoft, Google, and Amazon engaged in procurement battles that drove prices even higher on secondary markets. Taiwan Semiconductor Manufacturing Company, the foundry producing NVIDIA's cutting-edge chips, found itself at the epicenter of geopolitical and economic forces. TSMC's advanced manufacturing nodes, the 5-nanometer and 3-nanometer processes capable of producing AI processors, became strategic assets. Nations recognized that control over chip fabrication meant control over AI capabilities. The United States passed the CHIPS Act, pouring billions into domestic semiconductor production. China accelerated its own manufacturing efforts despite export restrictions. The semiconductor supply chain became the most critical infrastructure of the 21st century. AMD entered the race with competitive offerings, though perpetually behind NVIDIA's software ecosystem advantage. Their MI300 series chips promised performance rivaling NVIDIA at potentially lower costs. But the real story wasn't competition. It was total market expansion. The entire AI chip sector was growing so fast that both companies posted record-breaking revenues quarter after quarter. Behind all this activity was a simple economic logic. Companies believed that whoever trained the largest, most capable models first would dominate the AI economy. Size mattered. Parameter counts climbed from billions to hundreds of billions to trillions. Training runs consumed weeks or months of compute time across thousands of GPUs. The cost of training GPT-4 was estimated at over $100 million. Newer models were rumored to cost multiples of that figure. Money flowed into this infrastructure with remarkable speed. Venture capital, corporate treasuries, and government funding all poured into the same bet. That computational power was the key bottleneck, and that breaking through that bottleneck would unlock economic value measured in trillions. No one wanted to be the company that underinvested in chips and found themselves obsolete. Better to overbuy than fall behind. That psychology created the boom. And now, Musk argues, that same psychology has created the peak. Elon Musk's argument isn't that artificial intelligence is slowing down. It's far more nuanced and potentially more disruptive. He's arguing that the hardware purchasing cycle has reached saturation and that continued AI progress will increasingly decouple from raw chip acquisition. First, consider the physical realities. Major technology companies have already built or committed to building massive data center capacity. These aren't small investments. They're multi-billion-dollar facilities that take years to construct and decades to depreciate. Microsoft has data centers specifically designed around AI workloads. Google's infrastructure spans the globe. Meta's AI infrastructure investments exceed the GDP of small nations. These companies aren't just buying chips, they're buying land, constructing buildings, installing cooling systems, negotiating power contracts with utilities, and building out network infrastructure. Once that infrastructure exists, the marginal demand for additional GPUs changes dramatically. You can't simply keep adding chips indefinitely. You hit power constraints. Data centers are limited by electrical grid capacity, and expanding that capacity is neither quick nor cheap. You hit cooling constraints. Modern AI chips generate enormous heat, and removing that heat requires sophisticated systems that have their own limits. You hit space constraints. Even the largest facilities eventually run out of racks. You hit networking constraints. Connecting thousands of GPUs requires bandwidth that increases exponentially with scale. Musk has seen this firsthand with xAI, his artificial intelligence venture. Despite aggressive build-out timelines for what he's called the world's most powerful AI training cluster, even he acknowledges practical limits. There's a maximum useful size for current generation infrastructure, beyond which you're fighting physics rather than solving engineering problems. Second, training efficiency has improved dramatically. Techniques like mixture of experts, sparse models, and improved architectures mean you can achieve better results with fewer computational resources. The field is learning what the gaming industry learned decades ago. Raw power matters less than clever optimization. Companies that spent billions training massive, dense models are discovering that smaller, more efficient architectures can match or exceed their performance at a fraction of the cost. Third, there are diminishing returns to scale. Early in the transformer era, simply making models bigger consistently produced better results. That simple scaling law drove the land grab for GPUs. But recent research suggests those returns are flattening. The jump from 1 billion parameters to 10 billion produced remarkable gains. The jump from 100 billion to 1 trillion produces smaller improvements at massively higher costs. Companies are starting to question whether the next order of magnitude increase is economically rational. Fourth, many companies simply already bought what they need. When you're Microsoft or Google, once you've procured enough hardware to train and deploy your models, serve your customers, and maintain competitive capability. What's the argument for doubling your chip inventory again? The acute shortage that drove panic buying has resolved. Lead times have decreased. Availability has improved. The existential fear that drove overbidding has faded. Musk's insight is that we're witnessing a classic technology adoption curve reaching inflection. The hyper-growth phase of AI chip demand, where budgets seemed limitless and capacity was never enough, is transitioning to a mature phase where efficiency, utilization, and return on investment matter more than raw accumulation. But the story goes deeper than procurement cycles. Multiple technical and practical bottlenecks are emerging that no amount of GPU purchasing can solve. Power has become the defining constraint. Training large language models requires enormous electrical capacity. We're talking megawatts of continuous power draw. Data centers are negotiating directly with utility companies and in some cases building their own power generation. Some facilities are exploring direct connections to nuclear power plants. The electrical grid wasn't designed for the concentrated power demands of AI infrastructure, and upgrading it is a decade-long process in most jurisdictions. You can't just plug in more GPUs when the building's power capacity is already maxed out. Data presents another fundamental limit. Language models are trained on text scraped from the internet, but there's only so much high-quality human-generated text available. Companies have already ingested most of the readily accessible written content humanity has produced. Training runs are now incorporating increasingly questionable data sources, scraping everything from academic papers behind paywalls to GitHub repositories to YouTube transcripts. The easy data is gone. What remains requires expensive licensing deals, raises copyright concerns, or is of dubious quality. Data labeling creates yet another bottleneck. Training models to follow instructions, avoid harmful outputs, and produce useful results requires human feedback. That means hiring thousands of contractors to rate model outputs, write example responses, and provide preference data. This labor is expensive, time-consuming, and doesn't scale like compute does. Some of the most capable models are limited not by their architecture, but by the quality and quantity of human feedback they've received. Perhaps most significantly, inference costs are emerging as the real economic challenge. Training a model is expensive, but it's a one-time cost. Serving that model to millions or billions of users, inference, is an ongoing expense that scales with usage. As AI applications proliferate, companies are discovering that inference, not training, dominates their computational budget. And inference optimization requires different strategies than simply buying more training GPUs. These bottlenecks mean that even companies with unlimited chip budgets face constraints that hardware alone cannot solve. Progress increasingly depends on algorithmic improvements, better data curation, more efficient architectures, and solving problems that exist in the real world rather than in specifications of GPUs. The financial implications of Musk's warning extend far beyond the semiconductor industry. If AI chip demand is peaking, then markets built on assumptions of infinite growth face serious correction risk. Consider NVIDIA's valuation. At its peak, the company was valued at over $3 trillion, more than the entire GDP of France. That valuation wasn't based on current earnings alone. It was based on projections that data center demand would continue accelerating for years, that AI infrastructure build-out was in early innings, that every company in every industry would need massive GPU capacity. Analysts modeled hockey stick growth curves extending indefinitely into the future. But what if those projections were based on a temporary spike rather than a permanent trend? What if we just witnessed the largest one-time infrastructure build-out in computing history, and what comes next isn't continued acceleration, but normalization? The difference in valuation between those two scenarios isn't marginal, it's existential. History offers uncomfortable precedents. The dot-com boom saw infrastructure companies like Cisco and fiber optic manufacturers achieve valuations based on assumptions that internet traffic would double every few months forever. When growth normalized, valuations collapsed, not because the internet failed, but because the market had priced in decades of hypergrowth that occurred in just a few years. The infrastructure got built, demand was real, but it was front-loaded, and companies that bought assuming infinite growth found themselves with overcapacity. The AI chip market shows similar patterns. Companies placed orders based on worst-case shortage scenarios. Better to have excess capacity than miss the AI revolution. But that psychology means there may be significant overbuying. Data centers might sit partially empty. GPU utilization rates might disappoint. Companies might extend depreciation cycles rather than upgrading to next-generation chips on aggressive timelines. Cloud providers face particular risk. Amazon Web Services, Microsoft Azure, and Google Cloud invested tens of billions in AI-capable infrastructure, assuming they could rent that capacity to customers at premium rates. But if AI inference proves less computationally intensive than feared, if model efficiency improves faster than expected, if customers increasingly run models on device rather than in the cloud, those investments might generate returns well below projections. Startups betting everything on AI infrastructure face existential risk. Companies that raised hundreds of millions to build specialized AI clouds, that spent their runway on GPU procurement, that built business models around scarcity pricing, could find themselves with expensive hardware in a commodity market. When GPUs shift from scarce to abundant, pricing power evaporates. The correction, if it comes, won't be because AI failed. It will be because the market misjudged the timing and magnitude of infrastructure demand. Companies might have bought 5 years of capacity in 18 months. That's not failure, but it is a very different story than the one currently priced into technology stocks. And Musk's warning suggests that repricing might already be beginning. If Musk is right about peak demand, the technology landscape shifts in predictable but profound ways. GPU prices, which reached absurd premiums during the shortage, will normalize and potentially fall below list price. Secondary markets that saw H100s trading for $50,000 or more will collapse. Companies that hoarded chips as strategic assets will find that inventory is now a liability, depreciating hardware rather than appreciating commodities. The psychology that drove panic buying will reverse, and buyers will negotiate from positions of strength rather than desperation. Data center construction, which has proceeded at breakneck pace, will slow considerably. Real estate investment trusts focused on AI facilities will see growth projections revised downward. Construction firms specialized in data center build-out will face declining backlogs. Utility companies that negotiated premium power contracts with hyperscalers will see demand projections moderate. The entire ecosystem that grew up around AI infrastructure expansion will face a less favorable environment. But here's where the story gets interesting. The focus shifts from hardware accumulation to utilization efficiency. Companies with massive GPU clusters will face pressure to demonstrate return on investment. Utilization rates, performance per watt, and cost per inference become the critical metrics. It's no longer enough to say you have 300,000 GPUs. You need to show what you're doing with them and why that's economically sustainable. This transition favors different skill sets and strategies. During the boom, procurement and capital allocation mattered most. Whoever could buy the most chips fastest won. After the peak, optimization and efficiency matter most. Whoever can extract the most value from existing infrastructure wins. That's a fundamentally different competitive landscape. Software becomes the differentiator again. Companies that built the best training frameworks, the most efficient inference engines, the cleverest model architectures, they gain advantage. Pure hardware plays lose differentiation. When everyone has access to adequate computational resources, the winners are those who use those resources most effectively. The era of throw more GPUs at the problem ends. The era of build smarter systems with the GPUs you have begins. For the technology industry, this isn't a crisis. It's a maturation. But it does mean the explosive growth phase is over, and what comes next looks very different from what came before. As the AI chip landscape transforms, fortunes will shift dramatically. Some positioned for the old game will struggle. Others positioned for the new game will thrive. The winners will be companies that mastered efficiency before it was necessary. Anthropic's work on training smaller models that punch above their weight class positions them well. Mistral's focus on open-source efficiency-first architectures looks prescient. Any team that invested in mixture of experts, distillation techniques, or inference optimization will find their work suddenly valued much more highly. These weren't fashionable approaches during the scale-at-all-costs era, but in a world of constrained or stable hardware budgets, they become critical competitive advantages. Energy-efficient AI companies will command premium valuations. Startups working on neuromorphic chips, photonic computing, or analog AI processors, technologies that promise orders of magnitude better performance per watt, suddenly have more urgent product-market fit. When power is the limiting factor, anything that reduces power draw becomes extremely valuable. Even software optimizations that reduce training or inference power requirements by 10 or 20% translate directly to competitive advantage. Cloud providers with strong existing infrastructure win by default. Amazon, Microsoft, and Google have already built the data centers and bought the chips. Their infrastructure is a sunk cost. As the market normalizes, they're competing on operations, not procurement. Their scale advantages in power negotiation, cooling efficiency, and networking become more important than their ability to outbid competitors for scarce GPUs. The losers will be companies that bet entirely on hardware scarcity continuing. Specialized AI infrastructure startups that raised money to buy GPUs and rent them at premium prices will see margins compressed to commodity levels. Their expensive capital becomes a burden rather than an asset. Companies that leased GPU capacity at inflection point prices locked in unsustainable cost structures. Over-leveraged AI labs face existential challenges. Any startup that spent its entire funding round on a massive GPU cluster, assuming they could train a breakthrough model and monetize before needing more capital, now faces difficult questions. If their one shot at training doesn't produce a product that generates revenue quickly, they're sitting on depreciating hardware with no clear path to profitability. Companies betting exclusively on frontier model scaling as their moat will find that moat narrowing. When everyone can access adequate compute, the advantage from having slightly more compute diminishes. Differentiation moves to data quality, architectural innovation, product design, and go-to-market execution, areas where pure capital can't buy victory. But the end of the GPU land grab doesn't mean the end of AI progress. It signals a transition to a different kind of innovation, potentially more interesting and certainly more sustainable. Smaller, smarter models represent the immediate future. Research is showing that carefully trained models with tens of billions of parameters can match or exceed the capabilities of much larger models on specific tasks. This isn't about making AI less capable. It's about making it more efficient. A model that runs on a single GPU but performs as well as one requiring a cluster isn't a compromise. It's better engineering. Companies will compete to deliver maximum capability at minimum computational cost. Edge AI will accelerate dramatically. As models shrink and efficiency improves, more processing moves to devices, phones, laptops, cars, industrial equipment. This isn't just about privacy or latency, though both matter. It's about economics. Inference on a local device costs nothing beyond the initial hardware. Inference in the cloud costs money every single time. As AI becomes ubiquitous, the cost advantages of edge computing become overwhelming. Alternative computing paradigms will finally get their moment. Photonic chips that perform certain operations using light instead of electrons could deliver massive efficiency gains for specific AI workloads. Neuromorphic processors that mimic biological neural networks might excel at inference tasks. Analog computing, largely abandoned for decades, is being revisited for AI applications. When the focus shifts from raw flops to efficiency, these exotic approaches become economically competitive. Synthetic data will solve the data shortage. As companies hit limits on available training data, they're turning to AI-generated content to augment training sets. This creates interesting feedback loops, models generating data to train better models, but also offers a path past one of the fundamental bottlenecks. The quality and methodology of synthetic data generation becomes a critical capability. Energy infrastructure innovation becomes essential. Companies will invest in specialized power solutions, dedicated nuclear reactors for data centers, advanced cooling systems, power management software. The constraint shifts from chip availability to energy availability, and solving energy challenges becomes the new frontier. The post-GPU era of AI isn't about less progress. It's about different progress, more sustainable, more distributed, more focused on intelligence per watt than intelligence per dollar. That might actually be more revolutionary than what came before. Elon Musk's warning that we're moving from GPU shortage to GPU abundance isn't a prediction that AI will slow down. It's an observation that the industry is transitioning from one phase to another, from the frantic build-out phase where everyone raced to acquire hardware, to the optimization phase, where everyone races to use that hardware effectively. This matters because fortunes are built and lost at these transitions. Investors who understand the shift can position accordingly. Companies that adapt their strategies from acquisition to efficiency will thrive. Those that keep fighting yesterday's war will struggle. The AI revolution continues, but its nature is changing. The era of simply throwing more compute at problems is ending. The era of clever engineering, efficient architectures, and sustainable operations is beginning. This isn't less exciting. It's more interesting. When brute force becomes available to everyone, creativity and intelligence become the differentiators. For NVIDIA, AMD, TSMC, and the entire semiconductor ecosystem, this represents a normalization after an unprecedented boom. Revenues may stabilize or decline from peak levels, but that doesn't mean catastrophe. It means maturity. The chip industry has seen cycles before. This is another one. For AI itself, the implications are profound. Progress will come from different sources: algorithmic innovation rather than hardware accumulation, efficiency rather than scale, intelligence rather than brute force. That might lead to more robust, more deployable, more economically sustainable artificial intelligence. Musk sees the peak. He's positioned accordingly with xAI and his other ventures. The question for everyone else is whether they see it too, or whether they're still fighting to buy GPUs that might soon be abundant, planning expansions that might soon be unnecessary, and betting on a growth curve that might already be flattening. The AI chip wars aren't over, but the nature of the battle has fundamentally changed, and those who recognize that earliest will be the ones who win what comes next. If this deep dive into Musk's GPU warning opened your eyes to where the AI industry is really heading, make sure you're subscribed to Elon Musk Insights. We don't just report what Elon says, we analyze why it matters, connect the dots Wall Street misses, and help you stay ahead of the biggest technological and economic shifts before they become obvious. Hit that like button if you want more breakdowns like this, and drop a comment telling us what Musk prediction or warning you want us to cover next. We're building a community of people who think critically about the future, and we want you in it.